Have you ever wondered why, after a period of rising prices, things never seem to get cheaper again? It's a common frustration, a feeling that the good old days of lower costs are gone forever. This isn't just a feeling, it's a fundamental economic reality, and understanding it is crucial for everyone, from students to seasoned investors. One of the most common questions people ask during inflation is simple and reasonable. When things calm down, will prices go back to what they used to be? This query reflects a natural human expectation, a hope for a return to a familiar, more affordable past. It's a question rooted in personal finance and daily economic experience. For many, the frustration isn't just that prices rose, it's that they stayed stubbornly high even after inflation rates slowed. This pattern can be deeply confusing, leading to disappointment and a sense of economic injustice. If you've ever felt this way, this video is designed to explain why this phenomenon occurs, offering a calm, clear, and analytical perspective. We will demystify this economic behavior, providing insights valuable for financial literacy and market analysis. Before we delve deeper, let's clarify the scope of this discussion. This video is not about predicting future prices or offering investment advice. It's not about suggesting that prices will never, ever fall in specific sectors or for individual goods. Our purpose is purely educational and explanatory. By the end of this video, you will understand the core economic principles that explain why prices usually don't revert to earlier levels after inflation. You will grasp the powerful forces that keep them elevated and recognize why this pattern appears consistently throughout economic history. The goal is to equip you with a more accurate framework for understanding economic news, setting realistic financial expectations, and making informed decisions, whether you're managing a household budget or analyzing market trends. This understanding is a cornerstone of sound financial literacy. The fundamental misunderstanding often stems from how we perceive inflation. Many people intuitively think of inflation as a temporary state that, once resolved, should have an undo button for prices. Prices rise, inflation slows, and then, logically, prices should come back down. This intuitive leap, however, overlooks a critical distinction in economic terminology. Inflation, by definition, measures the rate of change in prices, not the absolute level of prices. When economists say inflation is slowing, it means prices are increasing at a slower pace than before, or perhaps even holding steady. It does not mean that prices are actively falling. This crucial difference alone explains much of the disappointment and confusion people feel after inflationary periods. It's like confusing the speed of a car with its current location. Slowing down doesn't mean you're going backward. Once prices move up, they establish a new reference point, a new economic baseline. This isn't just an abstract concept. It profoundly impacts businesses, workers, and consumers. Everyone adjusts their expectations, budgets, and strategies to this new, higher price level. This adjustment creates a powerful inertia, making widespread price reductions incredibly difficult to achieve. Lowering prices across an entire economy would require a complex and often painful series of events. It would necessitate costs to fall significantly, wages to decline, and countless contracts to reset downward. These broad-based reversals rarely happen because they introduce immense instability and economic friction. Businesses would face pressure to cut margins, workers would resist wage reductions, and consumers might delay purchases, anticipating further price drops. Economic stability, paradoxically, tends to come from holding prices steady at their new, higher level, rather than attempting a disruptive reversal. This phenomenon is a key consideration for market analysts and business owners alike. A major reason prices stabilize at higher levels is that many costs that rise during inflation are inherently sticky and slow to reverse. This stickiness is a critical concept in economics, affecting everything from personal budgets to corporate balance sheets. Understanding these cost components is vital for financial planning and market analysis. Wages. Wages are notoriously sticky downwards. Workers resist pay cuts, and labor contracts often include cost of living adjustments or are negotiated for fixed terms. Even in a slowing economy, employers are reluctant to cut wages because it damages morale, reduces productivity, and risks losing skilled employees. This means higher labor costs, once embedded, tend to persist. Rent and leases. Rental agreements for homes and commercial properties are typically long-term contracts. When inflation pushes rents higher, these new, elevated rates become the standard for subsequent renewals. Property owners have little incentive to lower rents unless faced with severe oversupply, which is rare after broad inflationary pressures. This locks in higher housing and operational costs for businesses. Input costs. While some raw material costs might fluctuate, many other input costs remain elevated. Energy prices, transportation costs, and the cost of specialized components often rise during inflation and don't fully retreat. Even if a specific commodity price falls, the overall cost structure for manufacturing and services has likely absorbed multiple increases across various inputs. Regulatory and compliance costs. These costs, often tied to government mandates or industry standards, rarely decrease. In fact, they tend to increase over time, adding another layer of fixed expense that businesses must cover through their pricing. Financing costs. During inflationary periods, central banks often raise interest rates to cool the economy. This increases the cost of borrowing for businesses, whether for inventory, expansion, or daily operations. These higher financing costs are then passed on to consumers through higher prices for goods and services. Once a business has locked in higher interest rates on loans or bonds, those costs persist for the life of the debt. Even if some individual input costs fall, businesses often cannot fully unwind previous price increases without operating at a loss. They have absorbed higher labor, rent, and financing costs, and these form a new, higher cost base. As a result, prices stabilize at this new, higher equilibrium. They do not retreat to pre-inflationary levels. This reality is a constant challenge for business owners and a key factor for financial analysts evaluating company profitability. This pattern of prices stabilizing at higher levels after inflation is not a new phenomenon. It is a consistent feature of economic history. Examining past inflationary periods provides invaluable lessons for financial literacy and market analysis today. Understanding these historical precedents helps align our expectations with economic reality. The 1970s stagflation, perhaps the most prominent example in recent memory, is the period of stagflation in the 1970s. Driven by oil shocks, expansionary fiscal policies, and wage price spirals, inflation soared. When central banks finally brought inflation under control, prices did not return to 1960s levels. Instead, the economy adjusted to a new, significantly higher price baseline. The cost of living, energy, and goods remained elevated, fundamentally reshaping consumer expectations and business models. Post-war inflation. Following major conflicts like World War I and World War II, economies often experienced significant inflationary pressures. Governments financed wars through borrowing and printing money, leading to a surge in demand and prices. After the wars ended and economies transitioned back to peacetime production, inflation eventually subsided. However, the price levels established during these periods largely persisted. The normal price of a loaf of bread or a car was permanently reset at a higher point than before the conflict. Supply chain disruptions, e.g., COVID-19 more recently. The global supply chain disruptions caused by the COVID-19 pandemic led to a surge in inflation. Increased demand for goods, coupled with factory shutdowns, shipping delays, and labor shortages, pushed prices upward across many sectors. As supply chains have gradually normalized and demand patterns shifted, the rate of inflation has slowed. Yet, the prices of many goods and services, from cars to groceries, remain significantly higher than pre-pandemic levels. Businesses absorbed higher shipping costs, increased wages, and invested in more resilient and often more expensive supply networks, embedding these costs into their pricing. In each of these instances, the adjustment did not mean that inflation failed to be controlled. It meant that the rate of inflation was brought down, but the absolute level of prices remained elevated. Economies adapted to this new baseline, and financial planning, investment strategies, and personal budgets had to adjust accordingly. This historical context underscores the importance of understanding price levels versus inflation rates for any serious economic analysis. While the idea of prices returning to lower levels might sound appealing to consumers, broad and sustained price declines, a condition known as deflation, are generally viewed by economists and policymakers as a significant threat to economic health. This is a crucial concept for financial literacy, as it explains why central banks actively work to prevent deflation. Discourages spending. In a deflationary environment, consumers and businesses anticipate that prices will continue to fall. This expectation leads them to delay purchases, especially for big-ticket items like cars, homes, or capital equipment. Why buy today if it will be cheaper tomorrow? This deferred spending can cripple demand, leading to reduced production and economic stagnation. Increases real debt burdens. Deflation makes existing debt more expensive in real terms. If prices and wages are falling, the fixed amount of debt owed becomes a larger proportion of one's income or assets. This can lead to widespread defaults, bankruptcies, and a credit crunch, further exacerbating economic downturns. Imagine owing a fixed mortgage amount while your income is shrinking. The burden becomes immense. Slows economic activity. The combination of reduced spending, increased debt burdens, and falling corporate profits creates a vicious cycle. Businesses cut production, lay off workers, and reduce investment. This leads to higher unemployment, lower incomes, and even less spending, pushing the economy into a deep recession or depression. Japan's lost decades are often cited as a modern example of the challenges posed by persistent deflation. Because of these severe risks, economic systems and monetary policies are designed to avoid large, sustained price declines. Central banks typically aim for a small, positive rate of inflation, e.g., 2%, to provide a buffer against deflation and encourage economic activity. Stability at a higher price level, therefore, is usually preferred to the volatility and destructive potential of widespread deflation. This is why the concept of normal often changes permanently after an inflationary period. The alternative is often far worse. To truly grasp the post-inflationary landscape, we need to adopt a more accurate and nuanced framework. The common narrative of inflation ends, prices go back is misleading. A more precise understanding is this: inflation ends when prices stop accelerating, not when prices reverse course. This distinction is fundamental for financial literacy and for anyone trying to make sense of economic news. Relief from inflationary pressures comes from stability and predictability, not from a nostalgic return to past price levels. When inflation slows or stabilizes, businesses can plan more effectively, consumers can budget with greater certainty, and the economy can find a new equilibrium. This new equilibrium, however, is built upon the higher price levels established during the inflationary period. This doesn't mean that the frustration over higher costs is invalid. It simply means that our expectations must shift from anticipating a reversal to understanding and adjusting to a new economic reality. For individuals, this means recalibrating personal finance strategies. For businesses, it means adapting pricing models and cost structures. For investors, it means reevaluating asset valuations and future earnings potential. Embracing this framework allows for more realistic planning and a clearer interpretation of economic signals. Let's re-anchor on the core idea that this video set out to explain. Prices rarely return to earlier levels after inflation because a complex interplay of economic forces locks in higher costs and expectations. Wages, rents, input costs, and financing expenses reset at elevated levels, creating a new, higher cost structure for businesses. Furthermore, the economic system actively avoids broad price declines, deflation, due to their destructive potential. Therefore, stability is achieved by holding prices steady at these new, higher levels, rather than attempting a disruptive and often unachievable reversal. Understanding this fundamental economic principle is incredibly empowering. It helps to reduce disappointment by aligning your expectations with economic reality. It allows you to interpret inflation news more clearly, distinguishing between a slowing rate of price increases and actual price decreases. Most importantly, it enables you to approach personal finance, business planning, and investment decisions with more realistic assumptions, fostering greater financial literacy and resilience in an ever-changing economic landscape. If you found this explanation helpful and gained a clearer understanding of why prices behave the way they do after inflation, please take a moment to like this video. Every like truly encourages us to create more informative and helpful content like this, empowering you with essential financial literacy. Share this video with anyone who might benefit from this crucial economic insight. Thank you for watching, and have a blessed day.